All right, we'll kick off. So today's a bit of a different one. We're mixing it up. We're doing a Q&A. So we've got two of our esteemed uh, advisors here at Lawpath. James Pham is our accountant. I'll introduce him shortly, and Molly Hamilton, one of our lawyers. She's also down based in Melbourne. Um, so it is Unfiltered. It's a live Q&A with our Lawpath's legal and accounting experts. We've got some of your questions which you've all submitted. However, seeing how we're going for time, if you guys have additional questions or follow-up questions, please don't hesitate to drop those in the Q&A chat box. These can obviously be around your business, but maybe you just want to ask something a bit more general in nature and broad as well. Pop those in the Q&A chat box there. Unfortunately, we couldn't add them all in. And largely, if we've actually not submitted your question, it's largely because that question in nature, or at least the answer we'd like to give you, is quite high level. And we would need to kind of dig a bit deeper, ask you a few qualifying questions, just to give you a bit of an answer there. So we will answer everything as best we can. But for most of you, I would recommend always having a one-to-one chat, perhaps with Molly and James after the webinar. We can certainly organize a complimentary call there. However, if they are actually at capacity for calls and they do get filled, don't worry, we do have a whole team of qualified lawyer and accountants that you can speak to. But if you already know, if you know, yep, I do need to speak to someone, I've got a potential issue or upcoming tasks I need to complete on the legal or accounting side, please do type yes into the chat, and we can reach out to you for that complimentary call and see how best we can serve your specific business needs. But moving on, let's talk first Lawpath. If you are meeting us for the first time, unfortunately, we've undersold ourselves. This 100 mil in legal fees saved is inaccurate. It's actually now over 500 million, but we have assisted over 500,000 businesses. We're actually Australia's largest incorporator of small to medium businesses, actually surpassing ASIC on that front, and actually on track now to hit 1 million by 2030. Who do we assist? Practically everyone. Bit of a rule of thumb, if you do have a small business, we can help you in some form or another. Think about 97% of Australia's economy of businesses is people like yourselves, small business owners. And these are your trades, your SaaS and tech companies, your consultants, recruiters, marketers, people, medical, cosmetics, mining, beauticians, e-com stores. You've got your brick and mortar stores like your restaurants and cafes, literally all sorts. And some of you might be familiar with us for our subscription services, which are tailored to you. Others for maybe reaching out to us on a more ad hoc basis. But let me introduce our keynote speakers. So first of all, we have Molly Hamilton. She's one of our senior commercial lawyers. She's been dealing with startups for 5+ years now, dealing with queries around IP, employment law, business structure. But if you do have any questions around like investment and capital raising, she tells me her favorite, so do reach out to her for that. And then we have James Pham. He's one of our senior advisors as part of Lawpath's tax and advisory. He's been an accountant for 12+ years. He can give you advice on all kinds of tax, like your GST, PAYG, capital gains, tax minimization, advice again on business structure, your payroll, your accounting software, all sorts. But if you do want to get some more specific advice around maybe tax strategy or budgeting and forecasting, he is your man. So what I'll do, I'm going to read off your questions one at a time. James and Molly are going to drop in and answer it to the best of their ability. For those of you maybe joining in a little bit later now, obviously we're doing this Q&A, but if you do have questions later on, do drop them in the Q&A box. And if anyone would like that complimentary free call, please type yes into the chat. But let's kick off with our first question. So question one, are there legal structures or agreements that could optimize tax outcomes? Are there any grants, incentives, or concessions I may be eligible for? Who wants to kick us off?
We'll take this one, Connor. Hello, everyone. Welcome to this Q&A session. Happy to be here. So this first question, are there any legal structures or agreements that could optimize tax outcomes? Yes, there are structures that you could implement that could help optimize tax outcomes, but it really depends on your individual situation. So, and sort of your family or personal goals as well. It really does depend on that and sort of the income level that you're projecting or forecasting as well. So the most common structures that we hear about that can optimize tax are mainly trusts and companies. So it really depends on your individual situation. So why a company? A company is taxed at a flat rate of 25%. And a trust is taxed. The trust allows you tax flexibility in income splitting ability. So you can utilize lower income members in your family group to attribute income to them, and ultimately that reduces the tax of the entire family group. And then, are there any grants or incentives available? Well, there are plenty of grants available at a federal level and a state level that can put some money back in your pocket. It really depends on what you are trying to do and what you are trying to achieve. Um, and different grants require different structures as well to be eligible for those grants. So this is a very broad question, but if I'm answering this from a high level, yeah, really, it really depends on the individual situation and what the goals are of the individual or the family group. I think that's it for that one.
Cool. All right, let's go to question 2 then. So, how to claim money you lent to your partner, as there is no written agreement to submit it to the court, and the only document is a banking transfer.
I'll take that one. Thanks, Connor, and thanks everyone for having me. So with this question here, I'm not sure whether, so in terms of not having a written agreement and loaning money, whether it's your commercial business partner or your domestic partner will make a little bit of a difference here, but I'll run over both briefly. So if we're assuming that it's a business partner that you've lent money to, a loan doesn't necessarily need to be in writing. Any agreement that you enter into, especially loans, we would strongly recommend that you are putting that in writing and signing off and having it really clear so you don't end up in situations like this. But now that it's happened, we can rely on an oral agreement. So that would be looking at evidence such as, like you mentioned, the bank transfer, but also the conduct of the parties. If there's any other messages, maybe from the person who loaned the money requesting it back or asking for timeframes. And courts will look at all of those things. Any acknowledgement of the repayment obligation or any correspondence that acknowledge the repayment, and even the bank account, the bank transfer description. Sounds like here you've only got the bank transfer. But again, worth looking at what if there was any description on the bank transfer, and there might be some more things that we could look into that you hadn't considered in terms of enforcing that. If this is the case, then definitely I would recommend scheduling a call with us so that we can discuss if there's anything else you can look for. But in any case, in this situation, you would begin with sort of a letter of demand. So you would engage a lawyer who would look at all of these facts and outline that in a letter, send a letter of demand to the person who supposedly owes the money. And then if that was not successful, sometimes during that stage, you can enter into sort of out of court without prejudice negotiation, where maybe you settle for an amount so you can save the whole court process. Otherwise, if that was unsuccessful, you would then look to raise that in your local court. But again, we would want to check whether you did have sort of sufficient evidence for a court to be able to consider and enforce. If this is a sort of domestic or romantic partner, it's sort of a little bit more in the family law context. And in that case, there's a higher standard to prove a loan when there's not a contract or anything in writing. So not only the things that I've just mentioned that I'd be looking for in terms of evidence, but also genuine attempts to make repayment or actually asking for repayment during the relationship. The reason for this is that it can often be treated as a gift or shared domestic expense as opposed to, a commercial business loan. So I would definitely sort of reach out in any case if you're in if you're in this situation to discuss further about what sort of evidence we could find and what your position might be and the best approach to taking that forward.
Awesome. Thank you, Molly. Let's go on to question 3. So if I trademarked my business, can someone else use that name? if, I presume this is they, put another in the front of it.
Cool. You're back with me, everyone. Back with the Kiwi accent. So, with trademarking, there's a lot to sort of consider, and it can be misleading because IP Australia has a great user-friendly website. So it often seems like, you can figure out a lot of things yourself doing trademark searches, etc. But there's a lot that goes on behind the scenes in terms of strategy and enforcement. So in this case, it's sort of a little bit of a depends answer, sorry, and that it depends in terms of what classes you're registering in. So if you wanted to register a word or name and you were operating, say, a beauty salon, and then someone wanted to register that name, same name for a banking app, then the IP examiners might look at that and think that it's in completely different industries and there's likely to be no consumer confusion. But in saying that, if you had a really distinguishable name that was a made-up word, for example, it wasn't an English word and it was associated with your brand, then that might be a barrier to entry for someone who was wanting to register it in a banking app, for example. The other thing that they'll consider as well is that if it's the exact same word, and let's say it's in the same or similar industry, they'll be looking at whether it has got enough distinction away from your registered trademark so that there's no consumer confusion. Um, I would say that largely you'll be protected in your space if it's not a plain ordinary word that traders are, wanting to use in the course of their business. So that's really the important part about the distinctiveness again as well. So considering whether the trademark that you have, is it a word that other traders in your industry would want to use to describe their services or their goods, in which case then they might be permitted, they might be more likely to get a trademark registered that had the same word with some distinguishing features. Hopefully that clarifies that answer, but if you had any follow-up questions, then feel free to drop them in the chat.
Awesome. Thanks, Molly. So question 4, it's a kind of a three-parter. So if they are 3 directors in a company, do all directors need to run day-to-day operations of the company? If there are just one director of the company, can he ask shareholders to work day-to-day operations? And third part, if I appoint someone as director, can I put his pay performance based, or I have to add a CPI every year, even if he hasn't met targets?
Cool. So I'll start with that first question in terms of director responsibilities. So directors are responsible for the day-to-day management of the company, but that doesn't necessarily mean that they need to perform all the daily operations themselves. So it's really important that directors of the company are familiar with what their director duties and obligations are. Lawpath has a couple of great articles online as well explaining what they are. But the most important thing is that directors can be held liable for decisions and consequences of the company. So it's the most important part is that they have oversight. So that means that you can delegate, daily operations to other people in the business, but ultimately directors are going to be held responsible. So if you are delegating a daily operation to another, perhaps an employee or a contractor, it's going to be the director's responsibility to ensure that that's compliant and done correctly. So it's directors are sharing the sort of governance as opposed to the granular daily tasks. In terms of a sole director requiring shareholders to work, oftentimes, I work in the startup space, so often there's founders that are directors and shareholders. So it's very common for the shareholders to be working in their capacity as sort of a director, or in some instance. But if it's a shareholder that is not a director, there's no legal obligation for them to work. That needs to be dealt with in a separate contract. So it does come up and perhaps frequently, especially in small business startup space. But in that case, the shareholder may be employed or under a contractor agreement, may be engaged as an advisor. And if that shareholder is not receiving fees for providing those, for example, if it was a contractor or advisor, if they're not being paid fees for that service, it can be attached to the equity that they're receiving as a shareholder as well, whether that's that they're earning shares going forward, so particular milestones, they may be issued new shares, or whether they're issued shares up front and they're subject to reverse vesting. So shareholders issued shares, they're required to perform ABC tasks under their advisor agreement. If they don't perform those ABC tasks, the company can buy back those shares, usually for a nominal amount. In terms of paying a director, so the question was if I appoint someone as a director and can I put his pay on performance based or do I have to add CPI every year? So paying a director can definitely be performance based. The most important thing is that it's all spelled out really clearly in a director's agreement or some type of arrangement with them where it clearly says what their KPIs and performance measurements are. And there's no legal requirement for the director fees to increase with CPI unless it's contractually agreed.
We'll just jump in here as well, Molly. On Molly's point about directors' duties, if a common scenario we're seeing at the moment is a lot of companies trading insolvent, which is a violation of one of the director duties, and we're seeing directors issued with director penalty notices, and that's to all directors. That's not just to the director working in the business; it's to everyone who's listed as director on the ASIC record. So it is the responsibility of a director to make sure that whoever they have in place running the operation, you're across those decisions as well. So it's very important to understand what's happening in the business if you hold the role of director in a company.
And if you're not sure, that was a great point, James, and just to add to that as well, is if you're not sure, like if you've become a director of a company, whether you were appointed by, maybe a family member or a business partner were already a director and appointed you, or you've set up a company and you're a director and you haven't really studied or become familiar with your obligations, I'd really recommend reading those Lawpath articles. And even we have hosted a couple of workshops, one-on-one sort of workshops recently, where we explain the director duties and make sure that you really have that under control. Because like James said, it can have large consequences.
Awesome. Thank you both. And yes, just to your question there, yes, if we do have time, we'll definitely jump on to your question around the company structure. Don't hold me to this, but I think there is a very similar question coming up, so you may get your answer there anyhow. However, if not, I saw you put down that you would like that complimentary call, so apologize for anyone who joined right at the very start. Just as a few more people did jump in later on. If anyone would like a free complimentary call with our legal or accounting team, please just type yes into the webinar chat there. But going on to question 5. So if no one holds shares in a timeshare that are in perpetuity, are one's offspring forced to accept them as part of the estate? Who's best for this?
So I wanted to answer this one quite generally and at a high level, but I also wanted to recommend that the person who asked this question perhaps, book in one of those complimentary calls and we can have a further discussion about the sort of specific situation, as it can be a bit of a complex answer. But speaking at a high level, beneficiaries cannot be forced to accept an asset and they, can usually disclaim the gift. And then generally speaking, if no one accepts, then the executed may sell, surrender, or dispose of the interest. So it applies to the contract as opposed to the automatic inheritance. But it would be, great to have a follow-up call with whoever this was so that we can discuss that in a little bit more detail and see where your position is.
All right. Thanks, Molly. Question 6. Can you please tell me a little bit more about trademarks and company structures for investment?
I absolutely can, because it's two of my favorite things. So setting up company structures for investment does really depend on sort of what your business is. But if it's any sort of operation where you're holding significant assets, so that might be including intangible assets as well. So maybe you're developing an app, or maybe you've bought a building or bought equipment. It depending on the investors you're speaking with, but if you're speaking to like sort of larger VCs, etc., they're probably going to want to see that you've got a holding company and an operating company structure, meaning that you've got one entity that operates and trades, so carries all your risk, and you've got another entity that holds all your assets and your IP, etc., protecting it from the risk in your operations. It's best, not only will some investors won't be interested, again, depending on your industry, if they see that you're operating out of a sole company, they might require you to step into the dual company structure. But at the very least, I'd say it's worthwhile thinking about it in advance, because not only does it show that you've researched and you know what you're doing, but also the process, depending on your situation, of sort of restructuring can take a little bit of a time, and depending on, we don't want to trigger any tax consequences either. Um, Another thing that, again, depending on the investors that you're speaking to, some of the sort of accelerator or startup partners or VCs also require that founders hold their shares through a trust. There's a lot of personal benefits that you get out of that, as well as sort of your separating liability again from the structure. But that can be something that you use over and over again as well. So not just for holding your shares, but for investing in another company or purchasing property as well. So that can be beneficial to you. It's worthwhile having a chat about your specific situation, I would say, in the lead up of investment, because it's nothing worse than having investors that are really keen and interested and then having to rush through the paperwork and having to quickly remedy the structure that was in place. A common one being that there's not enough shares on issue. And then sometimes that can take a little bit to fix, and then you're holding up investors, and you'd rather have that sorted beforehand. In terms of trademarking, as I mentioned, IP Australia has a great user-friendly website, but I would sort of recommend speaking to a lawyer about that process, because there's a lot of, as I alluded to earlier, there's a lot of strategy that comes into play. But essentially, the process that usually happens is that you would put in a Head Start application. So that's, you're putting in a sort of prelim application where you get a prelim result within 5 business days. With that result, you can kind of know whether there's going to be any issues that might come up, and what your sort of strategy going forward will be. After that, you convert into a formal application, depending on what the result was. And that application can take around 6 months, because even with a clear assessment, IP Australia needs to post it on the trademark register so that other companies can oppose it. And they've got a lot of requirements in terms of timeframes there. But then even further, if you have got sort of some issues with getting it registered, you might have to go back and forward with IP Australia a couple of times, and that can, drag on the process. So I would recommend, especially if you're planning to launch and or planning to invest a lot in terms of your marketing and advertising, then getting onto that ASAP, so that even that prelim result or the initial chat with the lawyer, you'll have an understanding of whether there's a potential issue, because there would be nothing worse than investing all that money into your marketing and logo and brand design to find out that you may not be able to get your trademark registered. And I might just, mindful of time, I might just add one more thing to trademarking, is that keep in mind as well that it's only when you have a trademark that you've got an enforceable exclusive right to use the name. So you don't need to have a trademark to operate. You can use whatever name you like, as long as it's not infringing on another trademark. But registering the trademark protects your interest over it and means that you can stop other businesses or companies using that mark as well. But yeah, feel free to book in the chat if you'd like to discuss that further.
Just on that point, from a tax perspective, trademarks are not depreciable assets. So they sit on your balance sheet until you sell the company or sell the shares in the company.
All right. Moving on. Can you tell me more about payroll tax within health/medical practice? This sounds like one for you, James.
Yes, I'll take this one. So yes, payroll tax is a state-based tax. So it changes from state to state. There is no specific rules around the health and medical industry. The only industries that are exempt from payroll tax, I think, would be religious organizations and potentially charities, I think, off the top of my head. But other than that, everyone is subject to payroll tax if you meet the relevant threshold. So, for example, in New South Wales, if you pay over 1.2 million in wages, then you pay 5.45% on anything above that in payroll tax on an annual basis. So, and then that's just not, and the way you calculate that, the New South Wales revenue will outline what is considered wages. So it does include gross wages, superannuation. It does include contractors as well, but there are exemptions. So, you just need to keep an eye on your total wages for the year to ensure that if you do hit that threshold, that you register for payroll tax, and you start lodging your payroll tax returns with the relevant state authority. If you have any questions about payroll tax and if it applies to you, we'll would have to book in a chat to discuss that and your situation, because it does obviously change based on the individual situation.
Awesome. Thanks, James. Question 8. I work in corporate contracting under AYG. I'm looking to set up an online side hustle where I offer digital products and potentially in-person services. What structure or structures would you recommend I consider setting up for this side hustle? We could talk for days on this. I don't anticipate large volumes of money initially from it, or can I receive income in my own name and bank account? Thank you.
Yeah, I'll take this one. So you'll have to make a call or a decision on whether what you're doing is commercial, or if it's more of like a side hustle and not a commercial setup, right? So this is a very gray area in terms of definition. It takes into account a lot of factors, whether or not the ATO views it as a commercial activity or not. So really think of, what are you setting up a website? Are you issuing invoices to customers? All that sort of stuff would probably lean to more of a commercial enterprise as opposed to a side hustle. And then in terms of the structure for this, if you're saying there's not large volumes of money in it initially, I would just probably advise starting by getting a sole trader ABN and starting it that way. It's low cost, it's free essentially. And you would need an ABN to do business in Australia anyway. So maybe start off with a sole trader ABN before you consider any sort of corporate structure. If the income level gets higher and higher, and you find the personal tax is creeping up the tax brackets, then you might want to consider restructuring this to a company to access that flat company tax rate. And also, if you think it's a particularly risky side hustle, then you might also want to consider incorporating so that you have limited liability as well. So it's good that you asked the question. Definitely get very specific advice before you go ahead and set up the ABN, and that way you have your bases covered from a tax and risk perspective.
Cool. I don't know if you want to jump in here at all, Molly.
No, that's great. Thanks, Connor.
No worries. All right. Question 9. I want to register a new business with my major shareholders from overseas. Any tips or advice with this?
Cool. So if you're setting up a company in Australia, the main requirement is that you have one director that ordinarily resides in Australia, but you can have overseas directors. That's perfectly fine. It just adds additional layers, in terms of whether it's banking, identity checks with the additional obligations that we have in Australia, and also in terms of cross-border governance as well can be a consideration. One thing importantly is whether you need approval from the Foreign Investment Review Board. So it's basically the government's check on foreign investment in Australia. It's not needed for every business, but it can be depending on sort of who the investors are and what the Australian company is doing, including whether the Australian company is going to be holding land. So depending on your sort of industry and who your investors are, that may be an additional consideration for you, seeking that approval. But aside from that, probably if approval isn't required from the Foreign Investment Review Board, considering whether the shareholders agreement will be really important. Shareholders agreements are always important, but in particular dealing with, for example, the cross-border governance and dispute resolution as well. So ensuring that if something goes wrong, being clear, where the jurisdiction and governing law is. So meaning that, if you needed to go to court or go through mediation, that process would be based in Australia with Australian laws. And what the process would be for them joining that dispute process, and also little things like ensuring that it's set up for correctly in terms of international entities, issuing their shares on ASIC, how they're entering your shareholders agreement. Small things like that can be important depending on where they're based. And also sort of considering as well, if they're planning to work in Australia, it's part of, if they're a shareholder and an advisor or whatever it might be, then the visa considerations there too. But if it's just an investor, then it would just mostly be what I mentioned earlier.
Yeah, would definitely recommend. I don't know if whoever asked this question is in the webinar today, but definitely taking this that conversation past this webinar maybe with Molly. I think recently I was looking at a lot of the key legal issues people have, and one of those might be like obviously issues with contracts or disputes, and I think it's like 1 in 5 business owners will um, have one each year, and one of the core ones on there was like your shareholders agreement and disputes around that. All right. Question 10. Look, I think we are halfway now. If we go over time, that's absolutely fine. More as a courtesy for everyone else. I don't know if you've got anything dead on 1 o'clock, but if we go over, it's absolutely fine on our end. For everyone who's put yes in the chat for that complimentary call with either Molly or James, or if they're unavailable, someone in our legal and accounting team. What I'll do is I'll give you a quick buzz after the webinar. If you don't pick up, that's absolutely fine. I'll flick through an email and we can set up a time I'll do a quick pre-screening with you before passing you on to Molly and James. And we'll go from there. So if you have joined in a bit later, just put yes in the chat if you want to set up that call. Excuse me. Question 10, interested in the 2026 planning and what can be done in the quiet Xmas break to get the best start for 2026? What should I focus on first? Great question.
I'll take this one, Connor. Yeah, so we're almost halfway through 2026. So as we go into this quiet Christmas period, it's probably a good time to reflect on the 6 months that have passed and see how your business has performed, whether that be against a budget or your own sort of expectations. And then maybe adjust the forecast moving forward and what you have planned in the next 6 months. If you don't have a budget or forecast in place, maybe this is a good time to sit down and do that. What it's good for is it actually forces you to think about what projects you have going on, what you're going to bill, what expenses are coming up, and really get an idea of what sort of profit you're looking at once you hit 30 June 2026. So then once you do that exercise, you can then look at tax planning as well for 2026, making sure that you have enough money in the bank to pay that tax bill when it comes due, as well as any other liabilities, whether that be GST, PAYG, and that sort of stuff, any other loans that are payable as well. So really sitting down and doing a budget or forecast would be my advice here, and then ensuring that you have sufficient cash or a plan to get sufficient cash into the business so that you can meet the liabilities and achieve the goals that you wanted to do. So, for example, a lot of e-com businesses would have been planning for this Black Friday sale coming up, and this would have been done in July, September, ordering the stock early, trying to negotiate the best price so they can maximize margins when the Black Friday sales hit, and then making a forecast on what type of volume they would be doing during these sales, and then ensuring that they're putting that into a forecast and then provisioning away tax and all other liabilities that come with doing business. So I think if you have an advisor, definitely booking a meeting with them. They can help you understand your P&L and balance sheet, and then give you a template to work on to forecast out the rest of the year. But if you don't have an advisor, have a chat to us. This is stuff we do on the accounting advice plan every day. This is my bread and butter. I love looking at this stuff. Strategic tax strategy and business advice as well. So definitely reflect on the year and then put in a forecast for the next 6 months and make decisions based on that forecast. That would be my advice. Thanks, Connor.
Awesome. Anything you reckon on the legal front, Molly, prepping for 2026?
I think generally speaking, I would, and this sounds like a plug, but I genuinely mean this, is that there's a lot of resources on the Lawpath YouTube channel, and it's whether it's our webinars that are recorded or whether it's training sessions, and they're all really clearly labeled as well, so you can sort of see what it's referring to. So I think if you're thinking about setting up a company, or if you're thinking about employing employees, if you're thinking about updating your contracts, you'll be able to find the specific advice there. And I think if you've got the time, sit outside in the sun with an Aperol spritz and tune into a our video. It's so much to learn on the channel. So I think it's a little bit of a tricky one in terms of what it is exactly that your plans are for 2026. But I would strongly recommend checking out the videos on there. I send them to my friends that are setting up businesses as well.
Absolutely. All right. Past halfway. Question 11. Is there a specific form of confidentiality agreement, contract, NDA to bind a white label supplier not to disclose their identity as a supplier for a particular brand?
Well, I was happy to see this question because I'm going to use this opportunity to debunk something that is close to my heart. This common misconception is that, and there's a million cases where an NDA is appropriate, and often it's before you're signing contracts or when you're initially having that discussion about whether you're going to enter a partnership or whether you're going to, engage a manufacturer or a supplier, etc. And there still is times that you need NDAs throughout the life cycle of the business. But this is a common question that comes up, whether it's for employment contracts, contractor agreements, white label supplier agreements, is that your agreement that you're entering into specifically for that arrangement, it's best to put your confidentiality clauses within that contract as opposed to having a separate NDA. So what you would do is have a really, like in this case, we would want to, in your white label supply agreement, put your confidentiality clauses in that agreement. Ensure it's tied to performance as well as and termination clauses. So meaning that if there was any breach of that confidentiality requirement, then it might give you action for terminating the contract. But also ensure in really clearly outlining those non-disclosure obligations and non-circumvention clause, but also giving yourself a right to for injunctions and damages. So injunctions meaning that you can apply to the court for an urgent decision to stop, something that might, if it's an ongoing confidentiality breach. So in this situation, and in many situations where you're concerned about confidentiality in a particular arrangement or commercial partnership, putting those confidentiality clauses in the main contract that you're entering into is often the best place for it. And if you need help drafting that clause as well, because it's going to be really important that, for example, the supplier identity is treated as confidential information. So in this case, if you need help drafting that clause or ensuring that the contract that you have already is going to protect you there, then feel free to reach out.
Awesome. Thank you, Molly. I might just interject because I don't think there's a question on this in the slides. Chris, I hope you might kind of just read off your comment, and Molly, I don't know if you can jump in here at all. Chris has put my expertise as cybersecurity awareness, and last week a national government publication featured my article regarding changes in law, plus responsibility and penalties relating to database access and privacy. Most people have no idea about their personal vulnerability now since July, fines up to 2.5 mil for an individual. Currently assisting an aged victim of a massive cyber fraud. Lack of knowledge of law and government and major institutions is staggering and costly. Do you have a cyber law specialist at Lawpath?
We do have some lawyers that it wouldn't be me, but we do have some lawyers in the team that we could introduce you to. So I'll make note of that, and we can coordinate after this call.
Awesome. Thanks, Molly. Thanks for that, Chris. Yeah, I think it's a very, very slept on topic and area of concern. Question 2, a three-parter again. A, how do I identify sham contraction of personnel? B, can a convertible note be prepaid without a specific power to the borrower in the agreement? C, can a director assume all control over decision-making of the company, may be given power to without resolution?
Cool. So in terms of sham contracting, there's a lot of different factors that come into play that are sort of balanced against each other to consider. So the main one, if we're talking here for those as well, in terms of sham contracting, if we're referring to the the sham contracting a contractor who should actually be treated as an employee. Um, James might jump in after me in terms of the tax consequences of that, but in terms of the legal engagement itself, is that what it's trying to protect against is that when you engage a contractor as opposed to an employee, the business or the engaging company has less sort of obligations to the contractor, and whether it's paying them annual leave or superannuation, etc., or giving them sufficient notice to end the engagement, or all of those additional employee benefits that you get. So sham contracting is referring to when you engage a contractor that should have been an employee, but the company is basically trying to get out of their obligations, or perhaps the contractor is getting less entitlements than they are entitled to. So the main thing that you sort of consider is like the difference between the two is that an employee is employed by a company to provide services for that company, and representing that company, that business, whereas a contractor operates their own business and are providing their services to that company as part of their arrangement that they're in. So it's things such as a contractor is going to be sending an invoice for their services. A contractor is likely going to be choosing their own hours or location of work, probably providing their own equipment, probably providing their own insurance if applicable, maybe not required to wear a uniform, not required to do additional duties outside of their sort of contracting services. So, for example, a Pilates instructor that is engaged as a contractor, they come in, they instruct the class, they leave. They don't wipe down the showers, they don't take the bins out, they don't, do the roster for the other contractors. So all of those things come into consideration like as a wide picture. So it's not a rule of thumb that a contractor can't wear a uniform for the company, but if they're wearing uniform and also all of the other things are in place where they're being treated as an employee, they're likely going to be on a sham contract. And the definition as well of employee from a tax perspective as well is worth considering if you want to jump in, James.
Yeah, definitely. There are a few pillars that the ATO uses to identify the difference between a contractor and an employee, independence, tools and equipment, or that sort of stuff. So the consequences of getting it wrong. So if you're an employer and you engage someone to do work for you, and you classify them as a contractor, but in fact the actual arrangement is an employment relationship or an employment engagement, and so you go ahead and you engage and they do work for you, and you don't withhold any PAYG and you don't pay them any superannuation, the responsibility actually falls on you as the employer, and the risk falls on you as an employer. So the ATO can come after you for all of that PAYG that was never withheld and all that super that was never paid. So, I generally advise my clients, if they're going to go get contractors, they should make those contractors set up a company and engage in that way. So that circumvents all of this. I don't think it's worth it to engage contractors through a sole trader ABN. It's just too risky to meet all the definitions that the ATO requires in order for someone to be a true contractor if the engagement isn't actually a contracting relationship. Most engagements are employer relationships. So if you want to go down this route of contracting, then as the employer, I would advise that you ask your contractors to set up companies and engage you that way. And then the liability is gone. It's a simple B2B transaction, and we are seeing quite a lot of that in the industry right now. A lot of big employers are contracting out to other companies and those other companies are just one man shows that are basically working on their own for the company. So to shift the liability, get your contractors to set up companies. That would be my advice.
Awesome. Thank you, guys. All right, lucky number 13. What are some approaches when dealing with larger clients with a single parent company and several subsidiaries that each request work separately and pay separately through one accounts department, creating an agreement headache?
Agreement headache. There's no such thing. We love agreements. So basically, I think what potentially from understanding your question here is that the easiest way to solve this is that you have a master agreement with the main company that you're engaging with, and then the subsidiaries will all be included under that. So it can be structured in many different ways. So for instance, there's a lot of flexibility, but like the classic example would be that you enter a master services agreement or whatever the contract is, a sort of master head agreement with the parent entity, and then the subsidiaries could issue individual work orders under that agreement. And then you basically, as long as that's set up correctly, and you can set out in the work orders about who's liable, who's paying, who can issue instructions. But the most important thing is that that's all set out really clear so that there's no confusion about who's required to do what and where you might be receiving funds from, where you're sending invoices from, who's responsible if an invoice isn't paid. And then considering as well, depending on the industry that you're in, like for example, if there's additional sort of regulatory requirements or maybe you're handling sensitive data or anything that has a sort of potential high risk space, you might also consider having the subsidiary sign into additional sort of base terms for consistency as well, especially if you're separating the liability between the entities. But that might be overcomplicating it for your situation. So I'd just recommend getting that master agreement in place, but really clearly defines what, the subsidiaries can be paying and engaging you as well under that contract.
Awesome. Thank you, Molly. Question 14. I'm looking to buy a small business. What important things do I need to know?
I think will be an accounting and tax and legal question. So I'll start off from an accounting standpoint. So this acquisition, you really need to define whether it's a purchase of shares in a business or a company, or if it's an asset purchase, right? And then I think what would be useful is to maybe seek out an independent valuation of that business to see if the asking price is within range of what the value of the business actually is. So I know for sure our tax team have done multiple valuations in the past 2 months, and we would be definitely happy to help you value the business to see if you're getting a fair asking price. And then once you get the valuation, then it's about negotiating with the buyer, right? The seller, and then meeting in the middle somewhere, so that because the two parties will have opposing goals here. The seller wants to get the highest price possible, and you as a buyer want to get the lowest price possible. So definitely get some independent valuation done on that business to see where it lands in reference to the asking price. And if you're buying shares in a business, which I highly don't recommend, that you will definitely need to do some due diligence on that company. So look at all the liabilities, the trading history, if there's any legal ramifications or legal action against the company. Because when you buy shares in a company, you're buying the entire history of that company and taking on whatever liabilities that company has. So those would be my main concerns when looking to acquire a business from an accounting and tax standpoint.
Thanks, James. And yeah, James is absolutely right in terms of that differentiation between purchasing assets or shares. As James sort of mentioned, is that the difference would be like, practically speaking, is if you bought the assets of a business, you would then likely set up a new company from scratch, fresh proprietary limited, and then those assets would be transferred into that company, and then you would operate from that day forward. So the most important thing with your asset purchase agreement would be ensuring, the quality of the assets, any ongoing warranties or liabilities, ensuring that you're not buying a dud machinery, etc., and anything that needs to carry on, and all the valuation considerations that James mentioned. Whereas if you were purchasing shares, then you're basically stepping in the door of that company just as it is, and you're taking over. So from whatever operations they've done, up until that day, you're assuming largely all of that responsibility, and you're just carrying on as normal. So that would include things like, as James mentioned, any previous legal action, any employee obligations as well as a big one. If there's any sort of like ongoing contracts as well, about ensuring you're fulfilling those obligations, and if there's anything that's gone wrong before you've stepped in. So in both of those situations, having really clear and reviewed contract is so important, because ensuring that, for example, you're purchasing assets, having a really clear inventory list, and, the quality of each, and if there's a warranty on each, and, what the process is for transferring ownership, what the timeframes are. So, we pay you on this day. What if you need to transfer a domain name or a trademark or, owning of a vehicle? All of that's going to be really important. And then even perhaps more so for purchasing shares, because we need to clearly, we want the seller to warrant that there's no ongoing legal action and that there's nothing that's likely to blow up when you take over. Sometimes there's going to be ongoing sort of handover obligations where maybe the leadership team are staying part of the business for a set amount of time for handover. Also considering, especially if you're taking over employees, calculating what everyone's, looking at all the contracts, looking at all the supplier contracts, all of the, third-party contracts that you have, but with employees, calculating what everyone's entitlements are, whether they're owed leave, that everyone's signed, there's no sham contracts. It's a really big job, and you definitely need a lawyer engaged for that process. There's a lot of documents to review, and the process, I think, can be quite overwhelming because there is so many documents. So just sort of going through step by step and making sure that it's not rushed because you don't want to miss anything.
Awesome. Thanks, guys. So going to question 15, my company owes me setup costs. What legalities do I need in place to be compliant?
Cool. So it sort of depends on this answer. So it sort of depends in terms of what your relationship is with the company as well. But traditionally, we might see a loan agreement in place, or whether it's a director loan, it can be treated as such. But whether it's a shareholder loan as well, but that will all need to be documented. And you'd also want to be speaking to someone like James about what the best approach is for you to take in terms of a tax perspective. But in this case as well, you'd want to follow the process in terms of governance and ensuring that there's a board resolution acknowledging the debt, and that it throwing and also proper bookkeeping entries as well. So that's going to avoid any breaches of director duties or related party transaction rules or tax problems as well. The other thing as well, it can be a bit of a conversation. It depends on, whether what stage of your business you're at, what it is that the setup costs are, etc. That sometimes that might be treated as, in exchange for shares. Again, you would want to be speaking to a lawyer and accountant about that to ensure you don't trigger any tax consequences that you didn't mean to. But whether that means that, you're holding a higher share percent. But I will say that it, completely depends on your industry and your type of business. But generally speaking, in sort of the startup space, especially, is that even in a case where, founders are setting up a company and they perhaps loan money to the company, almost always when bigger investors are coming on board, they're not wanting their, investment amount to be used to pay back the founders. And oftentimes, whether that's written off or more shares are issued or whatever it might be. But yeah, it's really important to make sure that that's all been clearly documented in terms of protecting your rights and interests, but also following the governance requirements for the company.
What about in a small business, a business where you're not going to get any future investment? What type of does it need to be a document in place for that amount that was loaned to set up the business?
It
What are your
depends
opinions
whether
on
there's
that?
other parties involved or not, right? So if it's just you and you're the sole shareholder and sole director, then perhaps not. But in terms of if there's other sort of shareholders or directors involved, then you might want to have a really simple loan agreement in place.
Yeah, great, awesome. And then and from a tax perspective, if it's just you're the sole director shareholder of the company, you loan the company some money for startup costs, then yeah, that's just basic bookkeeping entries to recognize that loan and recognize those expenses, because those expenses have tax benefits attached to them. So you want to make sure that you are recording those so that come tax time, you are paying the right amount of tax to the ATO.
Awesome. Thanks, guys. So we're nearly at 1 o'clock. We are going to keep going. Got a few questions left. However, I'm afraid it's my turn. Just have a quick plug in and just raise this with everyone. It's that time of year. I'm sure you guys know and have a list of things you might be buying for Black Friday. Maybe a few of you doing an early Christmas shop for yourself, or if you've got kids, you'll be looking at the Black Friday offers. We have one here ourselves. I'll be very brief on it. Happy to have a conversation on it separately if you are interested. We've got 30% off on our standalone plan, so just a single subscription on legal or accounting, or maybe just our basic essentials plan for the documents. But we are running up to 40% if you bundle all of our plans together. So it's exactly what it says on the tin. I don't need to oversell it. It sells itself. You get unlimited documents, the e-signatures, the legal tools. We've got over 500 of the documents. And then even better, you actually get unlimited 30-minute consults with our senior commercial lawyers or senior chartered accountants. To put into perspective, senior lawyers might bill anywhere between $400 to $700 for an hour of their time. Accountants are more around the benchmark of $250 to $500. We'll provide you with unlimited consultations throughout a whole year. With the tax plan side of it, we'll include your annual and quarterly BAS statements, business tax return lodgements done as well. And seeing as a few of you mentioned, actually, I think questions around business sale, business structure, IP, with the unlimited documents, we do have heaps of those related documents in there, documents on trusts, the shareholders agreement for your company setup, IP, like assignment of IP, documents, employment related documents, all sorts, too many to mention now. So we can discuss that later if you want to put yes in the chat. Or just get you in touch directly with our lawyers and accountants for that complimentary call. But going back to the questions, we're on 16. I need tax advice. I feel like I can maybe answer this myself. James, you want to jump in?
Yeah, booking a call with me. That's the answer there.
Yeah, we can certainly help you there. Question 17, is it better to liquidate or keep going?
Oh gosh, this question. This really depends. Again, the good old cop out. It really depends on the situation here. What is the situation? Have you been issued a director penalty notice? If that's the case, then you actually have 21 days to make a decision on whether you liquidate or you engage a liquidator and go through the small business restructure process where the liquidator will take control of your company. They will negotiate a payout of your ATO debt and other creditors, and then they'll hand back the company to you after that. So it's a way forward. But if a liquidator won't take on the task and they say it's not tenable, then you really don't have any other option but to liquidate. Otherwise, unless there's someone out there who's willing to float the business with money. So it really depends on the situation here. Where do you stand with the ATO? Have you spoken to a liquidator? Have you spoken to your accountant? Is there a way forward? If there isn't a way forward, then you really don't have a choice but to liquidate, because you do want to protect your personal assets. And if I think my advice here is don't stick your head in the sand. Just some action is better than no action. So if this situation is you've been issued a director penalty notice, just know you have 21 days to act, and that's not a lot of time. So definitely don't stick your head in the sand. If you don't respond to the director penalty notice, then you become personally liable for the debt of the company. So people think that a PTY LTD protects you from everything. It actually doesn't. If the ATO decides if you ignore a DPN, then the ATO can most definitely go after your personal assets to pay back any ATO debt. So, yeah, that would be my advice there.
Awesome. Thanks, James. Just to quickly answer your question there, Fiona, in terms of how to book for a call with specific people, I'll give you a call after the webinar to get you booked in with the most appropriate accountant, or most likely James. If it was in terms of the accounting advice plan, you can actually just pick whatever accountant you want to discuss to at any times and keep coming back to them. Moving on, question 18, information around an annualized wage arrangement and employment contracts with offset clauses and boot tests in light of the recent federal court ruling against Woolworths and Coles.
Also, for context, for everyone, the case that the question asker is referring to there, if you haven't seen it in the news, is essentially that there was a huge penalty that needed to be paid to, back pay, covering fixed annual salaries that were meant to cover overtime and penalties, but because they didn't track hours and employees worked more than expected, that the annualized salary was no longer better than the award that they would have been covered by. So that was the case that's referenced there, and the acronym BOOT test as well as the Better Off Overall test. So essentially, what this is referring to is saying that, in practice, if you have employees that are covered by a modern award, you can have an annualized salary that is, covered. You compare it to what the employee would have earned under the award, and if they are, paid more than what they were entitled to, then you can use that sort of annualized salary. But the most important thing is that you're constantly, and this is something that Woolworths didn't do, is that constantly reviewing the awards change and are updated, and also ensuring that you might have an annualized salary, like in this case where it's for a specific set amount of hours, and it's better than the award, and that's the BOOT test, the Better Off Overall test. So in that case, it might be that you employ someone and the annualized salary is completely appropriate. You've checked it and it's fine, but it's about continuing to review that they are better off overall, and that the employee comes out ahead but not behind. Because in the case that you fail the BOOT test, it becomes an underpayment, and then you would be required to back pay that employee. And in case when you've got big corporations like this is when they're spending millions of dollars fixing that because they've got, hundreds of thousands of employees. So the most important thing is that BOOT, the Better Off Overall test, is proven continuously, not just once. Your offset clauses, so that's referring to what the annualized salary is offsetting, should, for good practice, list the specific award clauses that are being offset. And also, keeping time records as well, because if it does need to go as far as court, if there's no time records and you haven't been following good record keeping, the court will assume the employee's version is correct. And modern awards do require written calculations, annual reconciliations, and there's a bit of a process that goes into it. So I think that it can be a mistake to assume that because you're bringing on an employee for an annualized salary where they're much better off, if you sleep on that, you could be in trouble. So you can check there's a great tool on the Fair Work website called PACT, PACT, where you can sort of calculate entitlements and also review modern awards that might apply as well. So I would recommend familiarizing yourself with that if you're engaging employees. And if you have any questions, speak to one of our lawyers here as well.
I'll add on to that as well. If you have employees employed under a modern award, every year you should be reviewing that award and reviewing everyone's pay. Just be ahead of the curve. Employment stuff, you don't want to underpaying is just a nightmare, and Molly will probably agree with that. Yeah, I think you just want to be proactive with this sort of stuff and make sure that you are up to date, because it is your responsibility as a business owner and director to be up to date with those employment awards. So put a calendar reminder in at 30 June 26. Just revisit the award that you are employing your employees under. They release a new modern award every year to reflect any increases based on any legislation that has passed. So make sure that you have some sort of reminder there that you go and find that award and review everyone's pay.
Yeah, and James, just a great point, and just even adding to your point from a legal point as well, is that no one likes paying a lawyer. Legal work is so important, and it can get you into whirlwind of trouble if you don't do it right. But particularly, people don't like paying a lawyer when it's because something's gone wrong. And in cases like this, where there isn't good record keeping, and it's a lot of going through old documents, backtracking, how much leave did they have, how many hours were they working, that can take a substantial amount of time for your lawyer to go through, and you can end up paying a big fee as well just to even respond to a claim or to prepare the evidence. So then, in that case, not only if you potentially underpaid an employee, but you've also got to engage professionals as well to help you work through it. And it's just an additional fee that you can absolutely prevent.
Awesome. Thanks, guys. Just to quickly answer your question there, Carol. So I'd have to double check if we are doing tax returns on behalf of accountants who are looking to become registered tax agents themselves. But in terms of, is it only advice packages? So there is a distinction. So we have a tax plan or tax compliance plan, which is just those lodgements. So it's your BAS tax returns, financial statements. It's not your installment activity statement. That's an add-on. But we do have a accounting advice package, which most people will just bundle with the tax plan, as most people do like to have kind of regular interactions with the accountant throughout the year, or at least that's what the ATO do recommend, especially if you have those quarterly BAS lodgements. Question 19. So if my ideal app name is already registered in a different industry, can I still legally use it as an app title? What's the
I
leanest?
might jump in. Should we do it question by question? Because there's a few here.
Go for it.
So in terms of that first, thanks, Connor. The first question is that, I've sort of discussed a little bit about trademarks earlier. So it depends. When we say different industry, there's still sort of related industries that IP Australia consider and like related classes. So for example, if you were going to register in class 9, they might say that some industries in class 42 are associated. And there is a rule and sort of test that they do as well to determine if it's a different industry. If it's a completely different industry, like the example I had before with the beauty salon and a banking app, that might be enough of a distinction that you can still register. But it completely depends, even considerations such as whether it would be likely that the beauty salon would then set up an app, not necessarily just a banking app, but there's a lot that comes into it. So without having the information of the specific sort of industries, I would say that in some cases, yes, but it's really important to sort of do a really do a formal review of the trademark register and the specific classes that's registered in as well. Thanks, Connor.
No, all good. Thank you, Molly. Did you want to go through all of them yourself or just?
I'll take the next one, Connor. Awesome. So the second part of this question is, what's the leanest setup to run multiple projects, app, merch, coaching under one ABN while staying compliant? So this can absolutely all be done under one ABN. It does, it does make it a bit hard from a record keeping perspective. If I was doing this, I would want to see. I would want to track profitability of each project. So that makes the bookkeeping a bit more complicated. So if you're planning on running these through under one ABN, I would suggest things such as a separate bank account for each project, and then maybe using project tracking in your accounting software where you are tracking certain expenses and certain revenues to a certain project. That way you can run P&Ls for each project there and keep track of how each business is going. Because if it's all lumped into one, then you don't really have a income, like a stream by stream view of the project. You just have a holistic view, which I don't think will help you assess whether one business is worth keeping on or if it's just eating into your cash flow. So yeah, just ensuring that your record keeping is airtight and will help you stay compliant with that, and that is the leanest setup. And then I'll take question 3 as well. When should a sole trader convert to a company, and what triggers make it worthwhile? So this question, there are only 2 considerations to this. So the first one is tax. So as a sole trader, you are taxed on the profit of the sole trader business. If that profit exceeds in a financial year, maybe that $130,000, $140,000, $150,000 mark, then you are being taxed at an average rate of around 25-26%. And any more after that, your average rate of tax keeps climbing up. So that might be an indication to you to say, hey, maybe it's time to move this business under a company structure. The other one is risk. So depending on how risky the business is, because as a sole trader, you bear the risk of the business. So anything that happens with the business, you are personally liable for those liabilities. So that is also consideration. So it's about balancing the two and then finding out which comes first, essentially. So with the tax, you have a pretty decent indicative figure of that 140, 150 mark before it becomes ineffective from a tax perspective, but the risk might come a lot sooner. So definitely keep those 2 considerations in mind when running the business. And then I'll take number 4 as well, if Molly doesn't mind. How hard is it to split brands later if I start everything under one ABN? Yeah, it would be hard. There will be tax consequences for this, especially capital gains tax implications if you were to move a brand to a new company or ABN, because that asset, that underlying asset would have value. So you would have to transfer that asset, and there's tax implications for that. There's costs to doing that, such as a valuation of that asset, because that transfer needs to be done at what's called market value. So I think here the leanest way to do it is to get the advice up front and figure out the structure for each of the brands, and then go from there. I wouldn't necessarily advise having it all under one and then restructuring later. That I think that would cost a lot more than doing it up front. I see. Yeah. Did you have anything to add there, Molly, or you feel that's all pretty good?
Yeah, that's perfect.
Yeah.
Awesome. Thanks, James. Question 20. So what? Or again. Do you guys just want to take it one-on-one?
Yeah, perfect. I'll take the first one. So the cheapest way to protect IP and brand names before full trademark. So if we're talking about like your brand name and logo, etc., without overcomplicating it, there can be an application that you can make for having a common law trademark. So essentially establishing that because you're using it and you've got market recognition, potentially when you apply for a trademark eventually, that you might be able to recognize that. But certainly in terms of brand name and logos, the only way you can protect it is registering a trademark. In terms of other IP, such as brand secrets or whether it's training materials or know-how, etc., keeping everything on a need-to-know basis. You can't register those as trademarks anyway. So this is for going forward as well. Keeping it on a need-to-know basis and ensuring that anyone that you're disclosing any sort of confidential IP to, it is outlined in that contract saying that it can't be shared. If you're sharing training materials with clients, making sure that they know they can't share it with anyone else, they can't commercialize it, etc. Number 2, what 3 contracts prevent 80% of startup legal issues? Number 1, shareholders agreement. If you've got more than one shareholder and co-founders in a company, you need to have a shareholders agreement in place. And I would strongly recommend that it's bespoke as well. Having this becomes your governing law. So many things can go wrong if you don't have a shareholders agreement in place, even if it's your best mate, your sister, your mum, your dad, possibly even more important in that case. Another one that I would say is not having engagement agreements, having what do we call it, a gentleman's handshake for business partners, etc., and not clearly outlining who's responsible for which, who owns the IP, who's responsible to pay funds. You then end up in a world of issues where you're needing to sort of rely on oral agreements and proving that, and you again spend more money on lawyers disputing that and to maybe get a little bit of money out of it, or maybe get what it is that you needed, whereas you could have put an agreement in place and saved yourself a world of pain. Number 3 is just off the top of my sorry.
I can take this one, Molly,
Okay.
if you don't mind. Yeah. Oh, sorry. You were going to the third contract.
Oh, sorry. Number 3 is in my third legal contract.
Yeah. Sorry. Yeah.
I will leave number 3, the question, to you. Number 3, legal contract. I would say this one's not so much a legal contract, but it does cause so many startup legal issues, is keeping your ASIC up to date. It can be, managing ASIC yourself when you first started the company might be okay, but as soon as you started bringing on other directors and shareholders, etc., I'd strongly recommend getting a lawyer or an accountant to help you, because fixing the cap table, I had a client that had a cap table that had been entered incorrectly for about 5 or 6 years, and he was seeking investment. Thousands of dollars later, months later, we managed to get the cap table up to speed, and all of that prevents investment and getting ASIC penalties, etc. So that would be the top 3 off the top of my head. And number 3 to you, James.
Awesome. What accounting system or habits give most clarity for small founders? So the easy answer to this is an accounting software that is connected to your bank account. Our recommendation is Xero, and I think that's probably the general consensus across Australia and New Zealand. Xero is the best one. In terms of habits, I could talk about habits all day, but the top, I'll give you 2. So staying on top of your bookkeeping in Xero and knowing the basic functions of Xero. I think every business owner should have some basic understanding of accounting, debits and credits, and the accounting software system. So I don't think it's a set and forget type thing. I think you really have to get in there and get in the weeds and really try to understand it on some level. I don't need you to be an expert, but you do have to be able to do most things. And then habits, I would say, I'll kind of frame this around sort of what I see go wrong quite a bit. I think having a system or process, MYB, uh, yeah, yeah, we can agree to disagree, Rod, on that. But the habits I would say would be to have a system in process to collect your debt. So reviewing your aged debtors on a regular basis to ensure that the work you have done and invoice for, you have some sort of system to go and collect that money because that money belongs to you. And then another one is a very basic one. When you go and set up your company bank account, make sure you have a normal everyday transaction account and then a tax savings account. And then having some sort of system in place to review your numbers and provision money away for liabilities such as GST, PAYG, super, and then income tax at the end of the year as well. So those would be my baseline recommendations for that question. Question 4, I already answered that in the previous question. Yeah, it would be through very airtight bookkeeping, separate bank accounts, using project codes in Xero or MYOB to isolate those, isolate the expenses and income per activity. Question 5, when do trust structures actually make sense for an asset or tax protection? Good question. It really depends on what your goals are, really. If you feel that there's an exit event in the future, or there will be significant wealth being generated in the trust or in the underlying asset, whether that be an investment property or shares in a company, then and you also have to have the beneficiaries in place to utilize the tax minimization potential, then it may be that a trust is the option for you. How about from an asset protection perspective, Molly?
I've put 2 links in the chat as well about that we've got on our YouTube channel around trust that I strongly recommend watching because it is quite a big topic. But in terms of asset protection, if it's when you're owning your shares through a trust, for example, anytime, I guess to put it at a really like basic level, is anytime that you're setting up a separate entity to yourself, it's a way of separating sort of like legal risk from each other. So if a trust is set up correctly, and depending on what the asset that you're holding is, such as a property, etc., then you can think of your trust as sort of a lockbox away from other entities or other operations or business that you run. But that's really dependent on it being set up correctly. If it's to hold your shares, I think actually James has covered that, but it's a big topic, so I'd recommend watching those videos if you have time.
Thanks, Mel.
Awesome, thanks, guys. We're gonna have a cat fight between the accountants on which is the better accounting software. And just to double down on that for you guys, Molly has put those YouTube links into the chat to our YouTube page. You have on there videos which are like our webinars, where they're generally around an hour. You can get some content there, or with a few which are just 3 to 4 minutes tops. They're bite size. Tim Quinn, our head of Lawpath Tax Advisory, actually even recently did a video comparing Xero MYOB pros and cons to both, I'm sure, so we don't discriminate. And do give advice on to small business owners if you're using those accounting softwares. Question 21 then. So husband owns a block of land. Husband and wife are shareholders of a company which pays for the construction cost of a childcare building, on the husband's block of land. The building is used by the wife to run a childcare center, which pays rent to the company. No lease agreement in place between the 3 parties. Husband does not receive any percentage of the rent. This structure repeats itself on a second block, all set up by the former accountant. What are the issues and how serious from a tax and legal point?
I'll take this one from a tax perspective. I know from a legal perspective, this would definitely need to be a separate consult, just because of how serious it actually is. So from my perspective, From my perspective, there are a few tax implications with this in the absence of a lease agreement. So the first one I would say is between the company and the husband. So the company is building a childcare building on the land. So in the absence of a lease agreement, the company has no legal right to that land at all to even build that property. So what that means is those construction costs are not tax deductible essentially because there is no lease in place. So that's probably the biggest one, the absence of the depreciation on the build of the childcare center. The other one would be, I think an even more serious one would be Division 7A implications. So this one's a bit of a hidden one where, so Division 7A is any sort of wage, like a benefit provided to a shareholder or associate. So in this case, the husband who owns a block of land, he's received the benefit. And the benefit is a building put onto his land, which has increased the value of his land. So essentially what the ATO reviewed this as is this value of the build will be a deemed dividend for Division 7A purposes, and that will be taxable in the husband's tax return as an unfranked dividend. And then the other one would be the rent between the wife and the company for that use of that building. So if there's no lease agreement in place, then the ATO will review this arrangement as a arm's length arrangement. The rent charge has to be market value. So and if in the absence of the market value, the ATO can assign one. And this arrangement here it raises a lot of red flags. So mainly Division 7A, and then the denial of a tax deduction for the build of the childcare center. So my advice would be definitely get those agreements in place, and definitely don't continue on this model moving forward for other blocks of land. That would be my advice. And it's a given. Definitely speak to a lawyer about this, about getting those agreements in place.
Yeah, that's exactly what I was going to say, James. I strongly recommend booking a call with a lawyer. This is possibly urgently as well.
Thanks, guys. If whoever did ask that question is in the chat, feel free to put yes into the chat box if you'd like that complimentary call to be set up. Question 22, a trademark application of my logo/company identification has been rejected on the basis of it not having enough unique features. What are the best next steps to protect my company brand and identity?
Book a call with me, because where there's a will, there's a way. We can almost always find a way, whether it's, adding a distinguishing feature that gets us one step closer, and there's so many options. It's rare that we're in a situation where we can't proceed. So I love a bit of creative problem solving. So book them with me and we'll have a chat.
Beautiful. Thanks, Molly. I think we're nearly there. So 23, what form of electric signature on contracts, employment, commercial purchases are considered best practice from a compliance and auditing perspective?
So in Australia, with all different states have different requirements here, and it also depends on what the contract is that you're signing, whether it's agreement or a deed. Also matters about who the parties are as well. So what I would say, generally speaking, if you're electronically signing contracts, ensuring that it's using a digital signature platform with an audit trail. Lawpath has that. Our e-sign feature has a audit trail that is legally binding and largely accepted. So that's the safest way to meet the compliance standards, and also making sure that your contracts have an electronic signing clause in it, permitting that people can, and often also signing in counterparts. So that means that maybe you're signing at different times, etc. But your witnessing is going to be important here. Sometimes if you're electronically signing and a witness is required, depending on your state, there might be a specific process you need to go through on your audio video witnessing link. So rule of thumb, use Lawpath or another recognized digital signature platform with an audit trail, but consider what state you're in, what type of agreement, and who is signing. A quick Google, you might be able to find some information from different law society links, etc. But otherwise, if you reach out to a lawyer on your specific contract, we'll be able to let you know.
Awesome. So, look, we won't take any final questions, to be honest. We're nearly at the 90-minute mark. I think it's the longest one I've ever done for webinars. But doesn't mean you can't chat to us after the fact. I've got you guys' details who said yes to the free complimentary call. Final roll call, then, if anyone does want that, please put yes in the chat now. The slides will go out via email from our marketing team. I'll also send out a more personal email from myself to check in, see if anyone has anything we can help them with. Um, and as I showed you guys quickly, sort of after halfway, we are promoting our Black Friday offers as well. I do like to sometimes shamelessly point out to people, it's $125 per month on like our legal or accounting plans, just separately as standalone. If anyone wants to Google it, I know this is cheesy, but it's less than what the average Sydney or Melbourne spender spends on their caffeine fix and their coffee or on their Uber Eats. So really, really incredible value for what you get for those unlimited consultations of our legal or accounting team. Um, Other than that, thank you for everyone who attended today. The recording will also go on our YouTube page where you can find other related webinar topics and those short bite-sized videos. Give us a follow on LinkedIn, Facebook, we're on TikTok as well if you're on there. And hopefully we'll catch you guys on the next one. And thanks, Molly and James, for participating and answering all the questions today.
Thanks, everyone.
Thanks, everyone.